Are you guys familiar with the lost decade in Japan? We're going to talk about it, reflect on it, and talk about possibilities for the US stock market, Bitcoin, risk assets. But we need to go back into history. A lot of you guys, most of us, we haven't been trading that long. I started in 2020. A lot of you guys started in 2020 with stimulus. Some of y'all have been here longer. Yo, the surf is crazy. Woo! Wow, yeah, I'm on my way to do a hiking tour, so I'm not going to be able to go out there today, but my goodness. Oh my god, it's maybe too big for me, actually. It looks crazy. Well, not too big for me, but not clean. Combination of being big and a little bit messy. Ooh, on the inside, my goodness, there's some big waves. Anyways, how long have you been trading? Were you trading in 1990? Probably not. So we need to look back in history. The past repeats, and the past repeats for fundamental reasons. So we need to study the past. And a lot of us, we look back at the last bear market and the last bull market and think that's how it's going to be. The 4-year crypto cycle, the next 4 years are going to be like the last 4 years. And while the past repeats, there's significant variation in what can happen, what a bull market can look like, what a bear market can look like. There's a book I can recommend to you guys called Devil Takes the Hindmost. It goes into detail on certain historical asset bubbles, including the Dutch tulip bubble, the tulip mania. It goes into Japan in the 90s. There's the South Sea stock bubble that happened in like the 1800s or something. It covers a number of historical bubbles. The one I want to talk about today is the Japanese bubble. And we're going to talk about possibilities for America and the world. Now, do your own research, and also, if you know something that I'm not sharing, please add it to the conversation. But you can look at the charts. I have some videos coming out where we talk about it. But there's this massive run-up on Japan 225 or the Nikkei 225 index that went for years and decades, and it peaked in 1990. The market bottomed in, I think, 2008, something like that. It was like an 18-year bear market. There were some rallies in there, and the stock market finally made a new all-time high in 2024. So it took about 34 years to make a new all-time high. Now, what caused the bubble and what caused the disinflating of the bubble, the puncturing of the bubble? Well, I'll tell you that the bubble was concentrated in real estate and it spilled over into stocks. But it's similar things that we see today in the US of a culture of buying stocks, a culture of investing in real estate, a culture of using leverage. I'm not sure on the interest rate environment then, so I can't really comment. But the bubble was so insane in real estate that at one point, the Imperial Palace in Japan, the land the Imperial Palace was on, which isn't a huge amount of land, was worth more than all of the land in California, which doesn't make sense, right? That said, if you look at the stock market, An indicator I'm going to keep talking about is the Buffett indicator, which takes the stock market capitalization of a country and divides it by gross domestic product to get a approximate overvalued or undervalued, where the gross domestic product, which measures everything produced inside that country by domestic companies, should somewhat equate to the value of the stock market, because the stock market are the companies that are producing goods inside the borders. So if we look at GDP, we take the stock market capitalization divided by GDP, that's the Buffett indicator. And historically, if it's under 100%, it's perhaps undervalued. If it's over 100%, it's perhaps overvalued. Does it make sense? If we look at bear market lows, oftentimes you get a reading of 50%. Stocks have fallen to 50% of GDP. They're very undervalued. All the leverage has been sucked out. The culture has moved away from buying, and it allows money to start coming back in. Now, in 1990, at the height of the Japanese bubble, the Buffett indicator for Japanese stocks was around 150%. And December 31st, 2024, right at the end of the year, coming into this year, the US stock market, the Buffett indicator, which is that stock market capitalization divided by GDP, the reading was 211%. So, in other words, the valuation of stocks in the US is significantly higher than it was in Japan before Japan had a 18-year bear market. If that doesn't scare you, then you're maybe too optimistic. By the way, how much insane value am I giving away for free while I'm driving my $2,600 Toyota Corolla? Anyways, the question might be, okay, bubbles pop, but why did it take 18 years? What really changed? There was a change in culture and a change in demographics. So during the bubble years, not only would Japanese companies do stock buybacks, but they would invest in each other. So they wouldn't hold a lot of cash in their balance sheet. It would be like if Apple holds Google stock, Google holds Apple stock, Microsoft holds Meta stock, Meta holds Nvidia stock, and so on. We see something similar but different in the US today, where there's a lot of stock buybacks, but typically companies are holding their own stock. But the point is, the corporate norm of buying back stocks, which is a form of financial engineering, is one of the things that kept valuations high and keeps valuations high today. So in Japan, one of the things that happened is the culture moved away from companies keeping stocks on their balance sheet and moved towards holding more cash. So that's one of the things that happened. There was also, the bubble blew up so badly that Japanese people were very much scarred, and the culture for retail investors moved away from investing in stocks. It's not normal, and hasn't been normal in Japan, like in the US, where you have a 401k and you're saving for retirement in that way. I'm not exactly sure how it is in Japan, but I think it's more about holding cash. You guys can correct me. But here's the change that should scare you a little bit, and part of that is demographic change. The US is lagging Japan a little bit, but Japan, the population started to get older, fertility rates started to decline, And with that demographic change, you have an older population. The older population is more consuming and less investing. They're more dispersing and they're less passive buying, right? So like we have the boomers today. The boomers are no longer buying stocks, right? They're beginning to live off their stocks. They're dispersing. So this is the change that happened in Japan. As the population got older, fertility rate goes down. The culture changes from passive investing to passive selling. And that old top-heavy age demographic is one of the things that caused there to be such a long bear market. Now the US is different. Japan is a little bit xenophobic. They're nationalistic, right? They aren't very pro-immigration. So when they like their own kind, when fertility rate goes down, their population goes down. The US has declining fertility rate, but they're propping up their population based on immigration. And continuing immigration is a way to keep young people coming in, buying stocks and assets, keeping that culture alive, and allowing it to compensate for the older population beginning to disperse. So I would say with confidence that the bubble we have is based on increasing population. That's one of the things. Now there's a possibility, and this is something that I've spoke about in depth on my other channel, which is that with fertility rate not just declining but in free fall around the world and globalization increasing, immigration to prop up the US population probably isn't sustainable. I don't have a timeline on when it'll go negative, but when that does happen, I'm not saying it's this year, it could be in 10, 20 years. It also might not happen. But when it does happen, what we'll see is we're going to see a lost decade. We're going to see what happened not just in Japan, but did you know that the US stock market from 2000, the tech stock market at least, the NASDAQ topped in 2000 and didn't make new all-time highs till 2014. It took 14 years to make new all-time highs. If we go back to the Dow Jones in 1929, do you know how long it took to make a new all-time high from the top? I actually don't know off the top of my head, but I think it was like 20 years, really long. These things will happen again. The past repeats. And when we talk about the bubble being in housing and real estate in Japan, not in stocks actually. I mean, there was a bubble in stocks, but it's primarily in real estate. Well, what's going to happen in the US when population tops for housing, right? We have a really old population of boomers. We have millennials and zoomers who, one, our generation doesn't feel as rich, right? It used to be easy to buy a house. It was easy to buy a house. And it was easy to invest. A lot of people are living paycheck to paycheck, or worse, actually living off credit card debt. There's not money for passive investing as much. So culturally, I would say we are moving away from it. That's why we see more speculation in stuff. My generation and Zoomers, a lot of them are speculating in crypto, altcoins, the riskiest of the risky. Not even risky, just trying to moonshot. Anyways, for the changing demographic of the real estate market, as boomers age out and millennials and zoomers are having kids at lower rates, what's going to happen to supply demand? There's going to be a glut of supply opening in the market, and there's going to be less demand. More houses less people. They're still building more houses. And again, how much can immigration patch that? We'll see. It's a good question, but at some point it won't. I'm saying at some point it won't, because the world globalizes over time, and the populations are declining in other parts of the world as well. So they'll try to prop it up as long as possible, but at some point the past repeats, which isn't just, the 2020 COVID crash, the 2022 bear market, but no, 2000 stock market bubble top, 2008 great financial crisis, 1990 Japanese market top, 1987 Black Monday in the stock market, 1929 the 70s. I haven't even gotten into the 70s into the US. It was like a lost decade as well. High inflation, low GDP growth, stagflation. The market didn't make new highs for like 10 years, or it came and tested the highs, 50% bear market, highs, 50% bear market. Has quantitative easing changed everything? It's created a big bubble. Can they keep doing that though? Maybe. If they want to, they can, but inflation is more painful for the constituents. So, especially when we talk demographic change, the asset holders care less about inflation because they're either profit from it or at least protected from it. But when you get a larger population of people who don't control assets, inflation becomes very, very, very unpopular. And you might think, well, who cares? I mean, or at least it doesn't matter. The population doesn't have very much control. And I think the population does, actually, at least. They can vote or pick this issue as the most important one. And also, if things get really bad, people get violent, there's more Luigi Mangionis that pop up and start offing, right? I mean, just like the past repeats itself, we could go back to revolutionary France. If the gap between the rich and the poor is too great, the guillotines come out, off with their heads. These things happen. I'm not calling for it. I'm not for it. I'm just saying that the past repeats. So it's really helpful to be a student of history and be prepared for these different possibilities, have investing and trading plans and life plans. And I'll tell you, for me, as time goes on, the more I like cash flowing business, of which I have several, the more I like cash flowing business, just because it's more predictable. It's more predictable, and these things are scalable. So there's opportunities, even if things top. Like in the 70s, you had gold and commodities you could invest in because of inflation. And I don't know if there was anything in 2000. I mean, the 2008 crash created an opportunity where you could come in and buy distressed assets. You could buy housing that's up for auction. The 90s might have been really bearish for Japan, but you could come in and buy the US. So there's different... Part of the past repeating is it repeats in different assets. There's always money chasing gains, so there's always asset bubbles that are forming. And asset bubbles, participating in the expansion of the bubble is the easier way to make money. You can be on the short side post-bubble. It's harder to do, but it's possible. But looking for that next bubble and participating in the early to mid stages of it. So, what is that? I'm not sure yet. I don't know yet. It might still be AI. It feels pretty late for that, though. We'll come back to this. Right now, it's just warnings and a lot of my market exposure is relatively market neutral. It's an arbitrage trade in crypto, and that's what the bots are. I'd like to trade MTP, and I am technically by not trading, but when things fall under the 200 moving average, we don't invest. So I'm waiting for another better opportunity there. Hopefully by the end of the year, but I'm prepared for it to be a long time. Anyways, appreciate y'all, much love. Talk to y'all soon, and see you in the comments, and check out the description if you want, if you're interested in what we're doing. Okay? Much love.